Hello folks, Charlie Gipple here. It is Monday morning, which is synonymous with the video of the week. I'm about 2 cups of coffee in, so I feel that my brain is starting to fire up for the week. And I thought, well, there's no time better than now to do the video of the week. What are we going to do this on? On Saturday morning, 2 days ago, I asked the question to my group, understanding already what the answer was going to be. I asked this question. Do you think it would be worth my time if I did a video on what are the expenses within indexed universal life insurance policies? And since then, about 4,000 people have viewed it. Several of you commented, yes, let's demystify this thing, and several of you like that. So again, I already knew the answer to that. I do 150 presentations a year, and I know there's a good amount of ambiguity around these expenses. I just didn't think to that extent. So anyway, I'm kind of excited to do this video. 2 level setting things here before we get started. The first one is if you're a consumer and not in the life insurance business, you may get confused when I talk this way. Well, if you have a client or if you have a consumer, this is the way that their policy is going to be affected. I would say just understand that I'm talking to 2 different audiences, that my group consists of 2 different audiences. One audience may be friends of mine that are not in the business, and you're watching this right now because you want to learn more about it from a consumerism standpoint. But the other group is, and probably the larger group is insurance company wholesalers, insurance company executives, agents, insurance agents, financial advisors, marketing organization executives, marketing organization wholesalers. So I'm talking 2 different audiences. However I feel like at the time, I'll refer to whatever audience I feel like at the time, right? So that's the first thing. The second level setting thing is even though I'm going to talk a lot about expenses, the volume of content I'm going to talk about in the next 10, 12, 30 minutes, I don't know yet, even though it may seem voluminous, that doesn't necessarily mean, wow, he's talking about 3 primary expenses here. It seems expensive because of the technicalities. There is not a direct link in the number of words that are going to come out of my mouth today and the percentage that is going to come out of a consumer's indexed universal life insurance policy. So my point is just don't get intimidated by all of this stuff. And all this stuff is actually, it's actually me giving more detail than needed rather than less detail than needed. So those are the 2 level setting items I wanted to talk about. So a consumer gives the insurance company $10,000. $10,000 is the gross premium. Gross premium. Well, what is the net premium? The net premium is after the first charge comes out. So I'm using this vernacular. There's a method to the madness. You may have seen net premium before on some policy. And net premium, what does that mean? Well, the net premium is that $10,000 the consumer gave the insurance company after the first of the big 3 expenses. I'm going to talk about 3 primary expenses within universal life insurance today. Now, some policies may have 4 expenses. Some policies may have 5. But to speak in generalities, something I'm very confident with, 99.9% of insurance contracts across the country have the big 3 of expenses. That's what I'm going to talk about today. The others, 4 and 5, I'm not going to talk about. Just understand there can be more. But the first of the big 3 is the premium load. So if a client puts in $10,000, let's say the premium load is 5%. That means that $9,500 is actually going to work for that client in that policy. $500 or 5% in this example comes off the top. Think of a A-share mutual fund. A-share mutual fund. Those have loads, right? 5 or 6% or so that comes off the top. Well, what do those loads in the mutual fund go towards? That goes towards the commission of the salesperson, right? Premium loads in life insurance go towards, yes, effectively that, acquisition charges to where that person that's talking to the consumer, they need to make a living, right? They need to get paid. They need to get paid by helping that consumer make a wise choice and demystifying some of this stuff. But premium loads can also go towards other acquisition charges, such as the APS reports, the doctor's reports that the life insurance company requests from the doctors. procuring that stuff costs money, right? It costs man hours. In addition to that, the paramed company coming to a consumer's house, taking the blood, having that consumer stand on a scale, having that consumer pee in a cup, that costs money. Premium loads help offset those acquisition charges. The second thing is, or the second expense of the big three is per thousand charges. Per thousand. So to explain the vernacular, the terminology here, what does per thousand mean? So let's say the life insurance policy, the death benefit is $250,000. How many thousands are there in 250,000? Well, there are 250, right? So the insurance company calls these per thousand charges or unit charges. 1,000 is a unit, again, to talk about industry vernacular, but 250 and 250,000, 250 units and 250,000. So the insurance company may say, okay, 250 times a certain factor, that is what we are going to charge the consumer on a monthly basis. On a monthly basis, we're going to charge a consumer that. What do per thousand charges go towards? Administration primarily, right? The home office, having lights on in the home office, having all those people hired in the home office to service the policy that the consumer has. That costs money, and that's what the per thousand charges go towards. By the way, what is the frequency in which the consumer is charged these charges? Well, there's one charge that kind of diverges from the others, and it's this one. Premium loads, as I talked about, premium loads come off the top whenever the consumer puts money into the contract, whether it's monthly, whether it's quarterly, whether it's annually, whatever the modal premium is, right? The per thousand charges, as well as the third charge, the big charge, which by the way is COI charges, these come out on a monthly basis. So, when I first got started in the life insurance business, I would look at illustrations. Okay, so $10,000 is going in. What is this $9,500? Where did the $500 go? And by the way, at the end of year one, how did this between day one and day 365 turn into this? That's effectively what I'm trying to explain here, right? But the third one here is cost of insurance charges. Cost of insurance charges, that's pretty obvious, right? Cost of insurance charges are, if there are 1,000 people in a group, the insurance company is going to have to pay death benefits on, say, 3, 4, 5, 50 of those people, depending on their health, depending on how old they are. Cost of insurance charges goes towards, well, that check that the insurance company has to write to the end consumer. So cost of insurance charges, those come out monthly as well. Here's the cool thing with cost of insurance charges. The cool thing with cost of insurance charges is with universal life insurance, indexed universal life insurance, you can adjust those, you can optimize those, you can make sure that, these products are like Ferraris, a little more complicated if you're a mechanic, but they can perform good. Why? Because they can be optimized if you are that Ferrari mechanic. Not every mechanic on earth can work on a Ferrari. What do I mean by that? Let me give you an example. Cost of insurance charges.